Well, welcome. I'm so excited to see everybody here. I get to talk about something that I absolutely love, which is setting agencies up to grow by acquisition. That is what we do. And I'm excited to give you an overview. I will tell you, we are building classes that are going to go far, far deeper than this. And we want to give as many people as possible as many resources to set you up for success rather than relying on what you might get online or by Googling something. So I really want you to know that what you read on a Facebook Messenger, Facebook post may not be true. And we're trying to set you up to make really strong, solid decisions. So let's just talk about what we're going to do here. This is actually part of a three-part summer series that we put together. We're actually putting it through our partners, where there's a couple networks that are using our content as well, and agents that we know can join. So first on this one, we're going to talk about before you buy, what you should know, and then how to evaluate your agency's financials and think about red flags that can be applied to your agency. It could be applied to agencies that you're looking at. And then the last is going to be about how do you want to think about structuring the deal. So this one is going to touch and hit an overview, and we're going to go deeper in session 2 and session 3. So feel free to join us. These are free. And again, our goal is to make sure that you have as much information as possible so you can make strong decisions. So today we're going to focus on number one, before you think about buying an agency, how do you think about your own agency and getting your own house in order prior to going down that path? All too often, people are surprised by the process of getting to a lender or evaluating another agency only to find that they really don't know enough about their own agency to make a solid decision, or by not having solid financials or a solid understanding, you might slow that process down. And if you follow me, you saw today that I actually posted on LinkedIn that there are far more buyers than there are sellers. So if you're not prepared as you're going to move into this process, you will lose out on opportunities or potentially get frustrated. So starting with yourself first and really thinking about your own financials, getting yourself ready, figuring out what you can do as an agency in order to strengthen your position, speed up that process, and be able to make strong decisions quickly. Second is, what's your strategy? What are you truly looking for? And what should you absolutely say no to when an opportunity comes up? Then what people should you put on your team to have in place so again you can keep that process flowing and moving forward? How do you evaluate the strategic fit between you and a potential acquisition opportunity? Identify the hidden risks and the hidden synergies that you might not think about, and you might not know to pay attention to in these acquisition opportunities, and then some lessons from experienced buyers. So that's what we're going to focus on today. Realize I didn't, talk about every single step of the process, but if we can get a really nice overview, I think you'll be solid and think about this in a different way. So before you start anything, you should make sure that your own data is clean, your own financials are clean, you know exactly what your profitability is, how you're managing your agency before you start
Lead
to
you right
bring
over
another
to an expert
agency
in the
or a book
store.
of business into your agency. If you don't do this, it might actually create friction when you go to a lender in order to buy. The lender is going to look at your financials and the combination of your financials and the financials of the agency that you're buying in order to lend. So if yours aren't tight, you're going to be building on a foundation that isn't quite as solid as what you need it to be. So number one, you should map your financials to the benchmarks to know where are you spending your money. Identify any opportunities to maximize your profitability by eliminating things that might be one-time expenses or discretionary expenses. So that could show up as a peak or a one-time. Over time, you'll be able to see that. But if you have your financials unorganized, you won't be able to see that year over year comparison in your financials. So, number one, get them organized in a way that makes sense. Number two, figure out what those discretionary expenses are, compare them to the benchmarks, figure out where you're low, figure out where you're high, and where you could possibly maximize your operating profit or EBITDA. Also know, what is your growth rate? What is your profitability rate? What are the things that you know? What is your retention rate? What are your loss ratios? So when you're vetting an agency, you know, are they actually enhancing what I have going on, or are they going to actually, put pressure on the agency as a whole and put something in place that doesn't make sense? So if you know your own KPIs, you're going to be far more better off than you would ever be. If you go into this not knowing your KPIs, you don't know what you're comparing to, you have absolutely no idea if it's strengthening your agency or weakening your agency. So, step one, know your own information and know, do I have the profitability that I would need in order to be a strong buyer? If you're operating at a break even for your agency, that means when you go to a lender, you're going to have all the profit to buy this agency coming out of the book of business or the agency that you're looking at. Most agencies, in order to be a competitive buyer, there's some synergy and they use their own profitability as part of that calculation. So getting a really solid look at your own financials will put you in the driver's seat and make you make far more informed decisions as you're going into this process. Second, so financials are one, but also in the part of getting your house in order, do you have capacity on your team for an acquisition? And if you did, who would be the point person on your team in order to manage that process of bringing that book of business in, integrating people, converting from one system to another? The body of work that occurs from doing an acquisition will create disruption in your agency. So if you're at full tilt capacity on your agency, it might not be the best time to be thinking about acquiring. So getting a really good read on where you are as an agency will tell you, am I positioned to even contemplate acquiring at this point in time? So if you don't know what I mean by comparing to the benchmarks and getting them lined up, you can actually download what the profit and loss chart of accounts is and look at the categories. This will actually tell you on your financial statements which expenses should be in which category so you can compare yourself to the benchmarks. Best Practices is just announcing their best practices agencies this past week, and they all have their financials mapped to these benchmarks so they can compare, am I operating in a strong way? Am I operating at what a best practices agency is? Are there areas where I'm under best practices? If your financials are not organized in the same categories, you won't know how to answer those questions. So this actually is a guide to help you get your financials organized in that same way. Okay, so why are you buying it all? I really think that one of the best things you could do is, why am I interested in acquiring and what exactly am I looking for? You have to take a really good hard look at your own agency and say, am I just looking to expand geographically? Am I looking to acquire talent? Am I looking to expand and have expertise in a niche that I don't already have? Am I just looking for revenue? Am I looking to fill some operational gaps? Am I looking for a partner, or am I looking to expand the footprint? So knowing what your goal is as you're running this agency will help you decide which opportunities that come up make sense, which opportunities are a hard pass, or which opportunities are maybe check some of the boxes, but not all of the boxes. And honestly, I think there are a lot of times that agencies get excited about a deal because it's an opportunity that came across their desk, and they haven't done this work, and they find that it is a lot of work. It maybe took their eye off the ball and it did actually not move them forward in the ways that they thought it was going to. So having clarity in what you're trying to accomplish by doing this acquisition will help you vet those opportunities. Um, what was left off of this slide is sometimes agencies would acquire in order to gain a carrier appointment. That was a strategy that was incredibly common during this hard market. I will tell you that is a strategy that doesn't work as well as it had before, if at all. So you need to be aware of what's happening in the marketplace. If that is your strategy, that for instance, there's an agency in Georgia right now that wants to have auto owners and they want to acquire an agency that has auto owners in order to get that appointment. Very unlikely that's going to happen because new appointments are not being handed out. So just understand what worked 4 years ago does not work in this current marketplace. So also ask yourself, is my strategy something that's going to work? And is it something that I'm able to execute upon? So knowing exactly what you're trying to do allows you to start making more strategic, less emotional decisions about acquisition opportunities that come up. How do you find opportunities? This might be the most common question that agents call me. Oftentimes, agents think that we are brokers. We are not, but we definitely have a lot of opportunity to connect people that are looking to buy or looking to sell, but that is not a service that we provide to our agents. We do have a pretty strong network of knowing who might be the buyers and who might be the sellers, but brokering and taking agents to market is not what we do. So, in order to have acquisition opportunities, you're going to have to network just like you do in order to get your own customers. You should talk to other agents. You should let people know that you are actually looking to acquire. You should talk to your state associations. Oftentimes, agents will go to their state associations and ask if there's a buyer's list. If there's a buyer's list, get on it and get vetted. You should talk to your carrier reps. Talking to your carrier reps could actually position you to find agents that might fit the expansion of you growing your book with this potential carrier. They also are really excited when they know that you have acquisition experience, it's gone well, and they can trust that they can refer people to someone that fits their needs. So the deeper your relationships with carriers, the more likely that you'll be able to have those referrals. There are online listings. There's things like Millibooks where you can go on and look for books of business that are for sale. There are Facebook groups. Insurance Books for Sale is a very, very active group online that you can go and look. There are aggregators. Inside your aggregator, there could be, or aggregator, cluster, network, alliance, whatever word you want to use. Those actually have active groups that are talking about who might be wanting to look and transition inside the network. Cake was rebranded to Millibooks. Great question. So when I say we're talking about Millibooks, they literally just changed their name from Cake to Millibooks. There's also direct outreach. You can absolutely make sure that you could be cold calling just like everybody else. You could go to networking events and let agencies know that you're interested. Um, you could do partnerships between CPAs, attorneys, and vendors. Here's one of the biggest things I will tell you. If your website has no information about you, if it has no videos talking about how you feel about your clients, if you have no information about your staff or things you do for your community, you are doing yourself a disservice. There are agents that are searching for someone to take great care of their clients. The number one question I ask when someone comes to get evaluation is, why are you getting evaluation? And if they're looking to sell, what's most important to you? The number one answer when I ask that question is, I want to take care of people. I want to take care of the people that help me build my agency. I want to take care of my clients. I want to take care of my staff. And then I would like to take care of my family. If an agent that is potentially looking to sell can't learn anything about how you feel about your clients on your website, they will go to the next agency if they're doing research and go to someone that they can connect with. Please put that information out there. It's great for your customers to see that, but it's also great for agencies that might be researching you. So This is a relationship business. There's no reason in the world to not put that video out there. There's an agency in New York that was looking to sell. She actually helped us, asked us to do some sell side work for her to help vet the opportunities for her. She picked an agency based on the video on his website, and he was not the closest agency. He was not the largest agency. And by all accounts, it actually, even their carrier makeup was closer to another agency, but she liked what he had to say about her customers, and she wanted someone that was going to take care of her customers, and he fit the bill and ended up actually winning that acquisition. So make sure that you are communicating who you are, because that fit in relationships really do pay off. Questions that buyers will ask themselves early is, what are the seller's goals post sale? Look for alignment in as many ways as possible. Or the other way to look at that is look at deal breakers as quickly as possible so you don't waste your own time and you don't waste the potential seller's time. These are long, long processes sometimes. They can take many times where it is an engagement where you know someone for a long period of time, but not asking some key questions that could be deal breakers for either side could really end up causing you to spend a lot of time and energy courting someone when it really isn't something that makes sense. So, how resilient is the agency? How reliant is the agency on one or two producers or clients? Now, look at the risk inside that agency. Do they use systems? Are they tech forward? Will they be will their staff be able to be integrated into your agency, or is it going to be a huge cultural gap with the way that you run your agency and the way the staff has been used to working inside another agency? Ask them about their ideal customer and listen. If it doesn't fit what your ideal customer is, they will tell you, but they don't know. So if I was a potential buyer, I would ask open-end questions and I would listen. And I'd be listening for, is this something that fits with us? Is it something that I can work with? If it's not something, then you should be thinking about um, exiting and not thinking about this acquisition at all. For instance, how many walk-ins do they have? How do they engage with their clients? How often do they engage with their clients? Do they pay? Um, think about this. And we will absolutely get to vetting the information, but these are just when you're having conversations and figuring out the synergies between you and them. Ask them how they pay their people. What is their compensation structure for who they call producers? The definition of producer is pretty loose from agency to agency. Ask how they get their new business and what that looks like. Bridging compensation between one agency and another can actually create a ton of friction and hurt your retention if you guys are miles apart in what that compensation is. So, really thinking about how healthy is their retention, what does their client look like, what does their staff makeup look like, and how close or aligned might it be to your agency. Ask it super early. If you've got deal breakers, know exactly what they are. Maybe not ask them directly, but ask questions that allow you to get to that as quickly as possible. And what must be true in any deal? If you're able to rattle off, I have to have these five things in a deal, or what are my deal breakers? The agents that know that are able to vet very quickly, and agents that don't spend a lot of time and energy on this and their eyes taken off of the ball of running their own agency, growing their own agency, because time is precious. So don't wait until the due diligence time to find out what your guardrails are. You should really be thinking that in advance. To give you an idea, one of my CFO clients actually acquired two agencies over the past 2 years. He actually vetted 22 opportunities in order to get two successful acquisitions in that 2 year period. Knowing what those things were, some of those were a very quick, let's take a look, vet against our profile. If it works, great. If it doesn't, move on. Some of them took longer than that because it took a minute to get to the information. But knowing what those are allows you to be very nimble in that process. Build your buyer team. Do not try and go alone with this. Have an M&A advisor or a consultant. That person will help you do the valuation or the assessment of the book of business when the time comes. Having a CPA that actually understands independent insurance agencies can help you with the deal structure, with the tax implications, all of that. And if you have a local CPA that's never done an M&A deal, you might miss some opportunities with some deal structure and tax implications. So please make sure you surround yourself with someone who has done this before, especially if not done it at all. Having legal counsel that's familiar with agency transactions is incredibly important as well. And identifying who your internal point of person for integration is going to be before you do this, not thrust it upon them and say, guess what? We got a whole body of work here. Like really having them part of the process and part of the vetting process will actually put you in a position of strength. Not having that and could really end up hurting your own team, which might be a well-oiled machine if you've not had them part of the process and thinking about what's that daily work going to look like. So those are the people on the team. I've put some of the people that we utilize on a regular basis. Manning Fulton is actually located is a law firm that's located in North Carolina, has done a fair amount of work for us. Agency Point has accounting and M&A law support, as well as CPA support for us. Live Oak Bank has been a great partner, as well as Westfield Bank. So just make sure that you surround yourself with people that have done this before. Fit is so much more important than financials and can be overlooked. If you're not asking about culture, leadership, communication, what the values are of an agency, if you're that could be something that actually is a pretty big deal breaker when you're trying to put teams together and create things that you're not thinking about. That is really hard to get to. So just looking at numbers on a page aren't going to cut it. Spend a lot of time, go to the agency, sit down with as much as you can the people, and think about when you want to communicate the process to someone. That is a very tricky part, but being able to have a line of sight on how their agency runs. Are there filing cabinets in their agency and you have absolutely none? You might have some cultural differences when it's going, you really need to make sure you see that for yourself. What is their process and their carrier mix? All of these things we're going to go through when to ask which questions and how to get through that process as smoothly as possible. But definitely take a look at their culture, their operations, their client mix, as well as their staff. Their staff is probably one of their most valuable assets, or it could be one of the biggest liabilities. There was an agency in Texas that was looking to sell, wanted top dollar, great volume, wonderful carrier mix. The only problem with this agency was 72% of the staff was going to transition within the next 2 years. 72% of their staff was beyond retirement age, which meant there was going to be a very, very big knowledge gap, potentially a very large retention problem, and a big staffing challenge for whoever took over this agency. So just because things look great on paper, getting those birth dates and hire dates and roles really makes a ton of sense. If you're only talking to the owner and you're not going deep enough in order to have a really good feel for what that staff makeup looks like, you could end up with something that is not exactly what you thought you were going to buy. So we're going to talk about the stages of discovery. The agency I talked about that vetted 22 different agencies in order to acquire two had started with, they were asking for all of the information up front in order to write an LOI, and learned I only need a certain amount of information in order to get to a letter of intent in order to make an offer and then do my due diligence. So we're going to talk about, and everybody has their own level of comfort, but that information gathering and the amount of knowledge that you need in order to make a solid decision, you allow your time, allows the person to make the process go smoother and work through the process and not stall everything on the upfront. So I'm going to look at some of these things. Oh, someone just mentioned that data is king. We're definitely going to talk about this because we see all the time that if the data isn't right, you can make a really bad decision if the data is right. So I'll talk about which things you can check data on and where it goes throughout this. So from the stages of discovery, first we're going to talk through initial fit. This is your conversation that you're going to have with an agency. It looks like this, where you would talk about which information to talk about. You'd love to know what's the ownership structure, what is the basic financial summary of the agency, what's their premium volume, what's their revenue volume, where is their profitability. They'll give you a description of the book of business, potentially a staff list and their tenure. Those are the kinds of documents you might get 1 year's financials in order to look at, and you can start asking some of those open-ended questions. Do we align culturally and operationally? Find out if there's enough surface level information to keep exploring. And does the seller have reasonable expectations? This is where you should start asking, based on what you know about them, what are your expectations? If you find that this person is a incredibly small agency that it's expecting 4 times revenue, you should probably put that to bed because that's probably not going to happen. So, finding out what expectations are from the seller early can help you from going through this entire process and not getting to a very fruitful end. So, again, initial conversations, make sure that you have your list of deal breaks and ask open-ended questions around those topics in order to find out, is this a viable option for me or is it not? Then you would go to, great, they've passed through all of the deal breaks, check off, all of the things look great. Now I'm going to ask for your current P&L and balance sheet. I'd love to have your book of business breakdown, your staff and producer compensation data, and a list of carrier appointments. By the time you get to this, you've signed an NDA. They feel comfortable about giving you this information. And then you have to ask yourself, does the revenue and the book of business information make sense? If someone hands you revenue and a book of business, a summary book of business report that absolutely the numbers don't tie, you should ask more questions. There is a data issue in that agency that you've got to dig deeper. Carrier reports, book of business, and a revenue and their P&L should be able to be tied, and the carrier reports, if nothing is tying the carrier reports where you can verify from an outside source what that revenue is, what you would go on. So, are there signs of risk or misalignment in the information that they've provided to you? If not, you would keep moving on and say, I'd love to know more so I can actually put a value on this agency. I would need trending information, so 3 to 5 years of financials. I would need your tax returns, your payroll records. I would need a complete book of business report so I can look at areas of concentration and risk by carrier, by client, by producer, by niche, by line of business. Now I can actually start to dig deeper and understand this. Have someone who has looked at this and can be as um, as objective as possible rather than trying to do it yourself. You then can actually start to look for what might be the add backs in order to get to the true profitability of this book when it can, and compare it to your agency. What are the things we could eliminate? Do we have 2 locations that are now going to become one? Do they have staff members that would not continue on? Might it backfill some of your staff members? Do you have carrier overlap that would create a contingency opportunity that did not exist inside in either agency without the combination of the two? What are their network relationships? Is there a first right of refusal that you need to take into consideration? There are lots of questions you would ask yourself, but now you start to be able to form, if you can ask yourself, are there any areas of opportunity and adjusted earnings or risk and synergies in this book of business that would put you to be a preferred buyer or maybe not a preferred buyer. Let's say you get that information and there's very little overlap between carriers. That could put some risk in that you might not be able to get those carrier appointments, and it might not make you the most competitive buyer for that agency. Are there compensation gaps? Did you determine their compensation for their employees is far outside the realm of what you're compensating your employees? And in order to bring these two together, you're going to have to make some compensation changes on one or both sides that would end up impacting the profitability of the agency. Does this agency offer benefits that are far better than yours? Might you have some people that would be upset by that? Lots of different things to think about, but now you can start to look at, is this a viable option? And it can inform what kind of offer you would make. Definitely need to dig deep enough in order to get to that LOI. The letter of intent is where you make an offer and the agency can know it. Once they accept that letter of intent, they cannot entertain any more offers. So the faster you can get to the LOI, the better. If you can't do a full valuation, you definitely need to get to what are those opportunities and risks, so you make sure that you can put together an offer that outlines a high level deal terms in your LOI. Things like what kind of staff would be continuing in this deal? Would the location continue in the deal? What would the seller's role be in the deal? What deal structure might make sense in this situation given the risk inside the agency? Would you offer a cash deal, a deal that had a retention clause, or potentially an earnout based on the circumstances that exist? So now you have enough information to make a solid offer, and you would know that if you engage someone who is a consultant or evaluation person, they can model and tell you, would it cash flow, rather than making an offer and then finding out, now I'm going to go to my lender, and based on the offer that I put in place, it will not cash flow, or I might not know that I have to put so much money down in order to have a loan structure that will cash flow. Most people may know this or may not know this, but if you have to have a bank loan, the bank will lend 90% of the value of the agency, but only allow you to use 75% of the combined profitability to service that debt. So you might think, I got plenty of money and I know it's tight on the first couple years, but the bank actually won't loan you enough money in order to satisfy the offer that you've made. By doing evaluation and having someone involved, you can avoid that kind of gap between what you think would work and what an external institution will make happen. So you need to make sure. That's why surrounding yourself with people who understand this and have done this before, it avoids those kinds of problems. When you do an LOI and a lot of the terms change in your due diligence process, that's where some deals can fall apart. So the more information you have to do and to put together a letter of intent that reflects this information will put you in a position of strength. But you are going to be balancing the amount of data that you're gathering versus the amount of time that it takes in order to make that happen. And you'll be battling some people that are not utilizing, external services and might be able to make quick offers and then might change the deal. So again, I think being as informed as you possibly can to make sure that your offer is sound is better than making an outlandish offer that you end up falling apart anyway. You then, once the letter of intent is signed, you go through the due diligence process where you take the current book of business, you tie it to the carrier reports, you verify that the revenue that's there is actually there. And that typically takes about 60 to 90 days to get to that close. So it really, then you're going through all of the contracts, the compliance, legal documents, your loss runs, and what all of those things are to make sure that you can go and verify the data that you have as accurate as possible so that final deal is as solid as possible. So once you do that, you'll determine, does the deal still work? Was everything that I thought to be true when I did the LOI actually true? Or does the price need to be adjusted? Does the deal structure need to be adjusted? Have there been changes on the staff? Have there been any lost accounts? Lots of information, but you should be as close as possible if you follow this in order to be able to get to a deal structure that makes sense. Here are some of the red flags to watch for. So, number one, declining revenue or lost accounts. If an agency is declining, you should know why they're losing the business, and is there something about their book of business? Is it a particular niche that's being lost? Is it a carrier appointment was gone, was lost? Is it related to a particular producer that was leaving? And are there potentially more lost business that might continue to occur? Through this process, you need to make sure that you are buying something that the owner owns 100%. If there are producer owned books or an absence of contracts that could make a question mark about who has ownership on the book of business, really important to vet that and make sure you know exactly what you're buying and what risk there is for the book of business. When there are no contracts in place, there is potential liability for a person to leave and try and take the book of business after a transition of ownership. And the last thing you want is to buy a book of business, be paying on that for the next 10 years, and have a producer leave and try and remove their book of business with them. So that is something to be very, very clear. What the retention rates are and what's driving the poor retention rates, or what's driving the loss ratios that are occurring inside the agency. I can't stress this enough. I think one of the people actually put this as their note. Lack of data or inaccurate data is probably one of the number one reasons that a discounted offer is done, or there's a retention clause put on the offer, or a holdback of a certain amount of money just to make sure that what we thought was true is true. So that lack of data or inaccurate data, an agency that's able to generate information quickly and be able to check between what's on the carrier reports, what's on the book of business, and what shows up on the financials, and they're all smooth and clean, is far more predictable than an agency that is not able to do that. Do they have outdated systems or compliance concerns? Is there a heavy reliance on one client or one group of clients, one producer, one single account manager, or a relationship like a referral partner? Any of those things could change the future performance of the agency, and you should know how much reliance is there and what impact could that potentially have on the ongoing performance of the agency. Conversely, there could be opportunities like a book of business that's not been cross-sold. It might be an incredible hidden opportunity in an agency, but there are some red flags. An agency that hasn't been cross-sold and hasn't been worked very well shouldn't command top dollar, because there's some risk in that book as well, but it could be a huge upside for someone. So know what kind of buyer you are and what your tolerance is for the risk that comes with an agency that might be declining, but definitely don't pay top dollar for something if there's risk factors clearly staring you in the face. Deals can be derailed for many, many reasons, and because of what you miss early. I think one of the biggest things that happens is you don't know your own agency enough or how to assess what those synergies are, or you overestimate what those synergies are. So, for instance, you might have a book of business and say, I think by putting these two books together, we'll have contingency opportunities for three carriers that we didn't. But what you didn't go deep enough to say is they're running so hot, or the type of business that they're placing with those carriers has risk enough that that assumption was untrue because of the quality of what's written with that book. Undervaluing the integration complexity. Day two of people, systems, locations, getting all of it, everything moved over to your code. It takes time and effort. Underestimating or undervaluing that complexity could be something that has ongoing expenses that continue with an agency, and you thought that it was going to go faster than what it was, that what it actually happened. Misreading the financial strength of an agency. Maybe that data led you to believe that they were growing, but that was not actually true. Not pulling out the contingencies, contingency income was lumped in with their total commission and fees, and it looked like they were growing. But what was happening was that was actually a declining book with contingencies that were folded in. Like not understanding the financials or the financial strength of an agency could really change the complexion of a book. Ignoring HR, legal, or compliance exposures. These are all things that can derail it. The thing that's not on this list that should be is producer-owned books or lack of contracts. And if you find out that this one person controls a pretty large amount of the agency, and it's unsure whether or not they're going to continue. So lack of continuing of key employees in a book of business, that could change whether or not you'd be interested in that book, because it creates risk with the retention of that book. So really staying in contact and understanding these risks are incredibly important in making really solid financial decisions. Just let's talk about valuations. Getting a valuation early on your own agency allows you to understand your own financial strength and positions you to be a better acquirer. It helps you look at the strengths and weaknesses in your own book of business, what helps you define what your target might look like, and thinks it helps you think about the profitability adjustments, the operating profitability adjustments in your own agency, which you can then apply to another agency. So by going through that process, you actually learn a great deal about your own agency, and it positions you to be a much more savvy buyer. It actually allows you to create time, create speed in the process as well. So you are not finding out and identifying all of these things when you're talking to a lender, which is at the end of the process or in the second, 2/3 of the process, when you could have known all of that information at the front. So this is something that we're going to go into pretty deep in those financial risks in the next session. I hope that you all will join me on that. There's some buyer insights that came from people who have done this before. So most people say day two was harder than we thought it was going to be. There's a lot of people that think, goodness, I got to the finish line, I signed the deal, and wow, I'm done with this acquisition. The work has just begun. Thinking about the planning on how you're going to tell your staff, how you're going to tell the staff of the other agency. What does that integration look like? How are we going to reach out to all of our customers? What does the work look like for notifying all of the carriers? So thinking about what that day two and how you're going to handle all of that communication is incredibly important and sometimes very underestimated. The next thing is we really underestimated the cultural mismatch. We overlooked the fact that our teams do not operate the same way. One had no procedures, one has very strict procedures. One has a lot of technology. These people were accepting cash payments from walk-ins. Like there's very different cultural makeups. So underestimating that and not thinking about the impact that has when you try and put those two teams together. Or not thinking about what happens if the talent doesn't stay. People unfortunately don't like change. So we didn't plan for what happens if the talent doesn't stay with us. And the last but not least is the financials look good until they didn't, until we dug deeper and we didn't actually understand what was in those financials. So getting someone who knows what they're looking at and can advise you could be a huge, huge help. So session two is really going to be talking about evaluating the deals, the financials, the questions, and the deal killers.